Welcome to another edition of Wealth Management Insights. My name is Lisa Shalett, the Chief Investment Officer here at Morgan Stanley Wealth Management, and today is Monday, February 2nd, and I'm recording this from our studio in Purchase, New York. After just 1 month, it's clear that the fourth year of the equity bull market may be different from the past 3. So far, the market has broadened out meaningfully from the Magnificent Seven companies. Price returns are more dependent on actual earnings, and policy proposals are becoming more populist and possibly less business-friendly ahead of U.S. midterm elections. But one thing has remained the same: the deep belief in the resilience of the U.S. consumer. Since spending makes up 2/3 of the U.S. economy, it's a critical part of the bull narrative for equities. However, we take a more measured view than most. In some respects, the assumption of consumer resilience is well grounded. Against the odds, spending grew at a robust annualized rate of 3.7% last year, and if we adjust for inflation, that rises to a stellar 6.5%. That growth came despite strong headwinds from tariffs and a softening labor market, with very low job creation, slowing wage growth, and declining consumer confidence. The consensus now is that if Americans kept spending through all of that, then of course this year, when $150 billion in tax refunds arrives, falling gas prices and better small business sentiment can only add fuel to the fire, perhaps. When we delve into the details, however, we see several reasons to be cautious regarding the U.S. consumer in 2026. First, U.S. savings rates have dropped significantly from 6.4% in January of 2024 to 3.5% today. And at the same time, real personal income growth has decelerated sharply from 3% in 2024. These numbers suggest that 2025 spending may have been funded primarily by savings. Now we fear that tax refunds may be used to rebuild savings and pay down debt, especially given the uncertain job environment. The second dynamic is the K-shaped economy. Compelling analysis shows that households in the top 20% by income have benefited more than other groups from strong market returns and rising home prices over the past few years, and have therefore accounted for an outsized share of spending. These households are also expected to benefit the most from the new tax law. But if this high-end segment shifts in any way their spending preferences, or if the actual markets enter a downturn, the resilient consumer story could quickly change. Finally, consumers' anxiety over the future has been running high, and it's hard to see it cooling anytime soon. Angst over affordability and the threat to jobs from AI is not new. But this year, companies are likely to come under even more pressure to demonstrate productivity gains from implementing Gen AI, which could quickly lead to layoffs. While populist policies could be a salve, the effects would be short-lived if history is any guide. For any of these reasons, the resilience of the U.S. consumer is not a given, certainly not in our view. In fact, we think it may be tested by mid-year, and we thus remain selective in consumer sectors and consumer stocks. Instead, consider focusing on earnings realization versus some of the overhyped themes. We suggest taking profits in high beta, unprofitable, small cap, micro cap, and speculative equities. Redeploy those to large cap core and quality names. We also favor broadening your exposure to Gen AI productivity beneficiaries who may be in sectors like financials, healthcare, and energy. For passive investors, balance market cap weighted exposure with equal weighted and consider employing active management for up to 50% of your allocations and adding to rest of world equities with a focus on emerging markets. Hedge funds and real assets, including commodities and infrastructure, also remain key allocations. For this and any other questions about portfolio strategy or financial planning, as always, please reach out to your Morgan Stanley financial advisor.